Late-stage delinquencies rising as K-shaped economy continues to persist. Personal loans and credit card originations rise, a sign of healthy consumers or those just seeking liquidity. And average balances climb, but utilization stays broadly the same. I'm Jeff Richardson, host of Credit Gauge Live, and I'm joined as always by my colleagues Susan Fay and Atif Mirza. Lots to get into this December. Let's get right into it. Susan, first question to you. How are consumers handling their debts as we head into 2026?
Thank you, Jeff. So this month, we saw late-stage delinquencies rise approximately 0.24%, representing a 30% increase year over year on a relative basis. And when you look at early-stage delinquencies, they increased also, but at a much lower rate, and middle-stage delinquencies have remained flat. So what this tells us is that the increase in late-stage delinquencies has been an upward trend now for a couple of months. There's a subsection of the consumer population that is having a persistent repayment strain. And because of that, this is where you're seeing that bifurcation of the U.S. consumer economy.
Thanks, Susan. That's the K-shaped economy we read a lot about. Atif, over to you. We talked about balances. So consumers are keeping high balances. That could be they're just using credit more than before, or they're just rolling balances over. What are the trends you're seeing?
What we are seeing is the higher balances, but not heavy credit use. In November 2025, average balances rose to $106,000 in November 2025, which is a 1.4% increase from last year, but only a slight uptick from October of 2025. At the same time, when we look at utilization rate, that stayed essentially flat and even ticking down a little bit, which tells us that the consumers are not maxing out on their credit use. They are carrying larger balances, but they are cautious about their available credit.
So exercising some restraint in how they use their credit. Susan, last question to you. It's the holiday shopping season. This is typically when we see a lot of retail cards and credit cards getting opened. What's happening in terms of origination?
So in November, consumers appeared to be seeking short-term liquidity for their shopping. So we saw an increase in new account originations for both personal loans and credit cards. Year over year, personal loan and credit card new account originations rose the most compared to all other product types. So with personal loans, for example, we saw an increase in November of 2025 of 0.56% compared to the same period last year. And for credit cards, there was an increase of 0.24%. And so what this shows you is, as we were entering the 2025 holiday shopping season, household budgets seem to be tighter than they were a year ago, and consumers are seeking out short-term liquidity through personal loans and credit cards as they went into the holiday season.
Thank you, Susan. Thank you, Atif. These are really important trends to keep an eye on, and I can think of nobody better to actually dig in with them a little bit further than our special guest this month, which is Massoomi. Mani is the Chief Risk Officer of Patelco, which is one of our nation's largest and most sophisticated credit unions. Stick around. We'll be right back where we'll talk about credit trends and the holiday shopping season with one of our experts. Welcome back to Credit Gauge Live. I am delighted to be joined by our special guest this month, Massoomi, who is Chief Risk Officer at Patelco, which, as I mentioned, is one of the nation's largest and most sophisticated credit unions. Mani, you've had virtually every job in finance, so I can think of nobody better to speak about these issues, particularly because right now your finger's really on the pulse and you guys are making credit decisions really every day.
Yeah, Jeff, thank you so much for having us. It's an honor to be here. And thank you for the compliments. We tried to stay ahead of the game, but VantageScore support has definitely been instrumental for us to stay that way.
Oh, thank you for saying that. So let's get right into it. We're in the midst of the holiday shopping season. What trends are you watching for in terms of member spending and credit usage? And how do those insights shape how credit unions support members and financial inclusion?
Yeah, Jeff, thank you for the question. I'll just provide like a few things that are items that we're watching here from our perspective. There's three things really, Jeff, and none of this is probably going to be a surprise to the audience, but we're definitely seeing a lot of credit card usage. Typically, this time of the year brings a lot of leverage, and we're seeing, and the data showing that 50% of people are using credit cards. We just hope that they're not really getting over their skis from a debt perspective, that they're remaining in a place where they can pay it off. The second thing is just digital and contactless payments. I think for anybody that has children, they've seen cash is gone. Everyone's using cards, Apple Pay or mobile payments, and that's done a lot to speed up transactions, and I think we're seeing quite a bit of that. And then lastly, something that you and colleagues are very aware of is this whole concept of buy now, pay later. BNPL has really taken off. I think something we watch there is what is it being used for. I think that data is important. If people are using it for TVs or large purchases or semi-large purchases, we're okay. But if people are using it for their day-to-day milk and groceries, etc., that's a barometer risk, that we're seeing. And then regarding our actions, Jeff, and this is just something that we do, and I'm sure a lot of other peers are doing it as well. We're trying to provide flexible, affordable credit options like holiday loans, credit line increases during this time, and skip a pay. I think providing members some flexibility hopefully will help on the other side from delinquency perspective. The other thing is we're doing a lot of education, financial wellness, to try to provide members with some backdrop regarding expenditures and the sort of things they should watch out for. And then lastly, something that's near and dear to the credit union world, Jeff, we do a lot of community-focused relief. So we've done toy drives, we do food donations, essential programs. I think these things hopefully will go a long way during the holidays.
Really interesting, Monty. Want to pivot just slightly here. What do you think is the biggest emerging risk that you're watching for right now? And what do you think the industry is overlooking when it comes to the members that credit unions serve?
Yeah. So I think, Jeff, everyone talks about synthetic ID fraud and those sort of things. I'm not going to give you that boring answer, right? So what I rather focus on is what's happening economically. I think a lot of us have heard about this K-shaped recovery and what that means. I think that duality is very real and present. I think there's a financial wellness gap, right? I think inflation-driven liquidity stress among members is something we're seeing, is that not everybody's having a great time during this stock run-up. I think those that own homes, those that have been already involved in the stock market are benefiting from it. But sadly, that's not the case for everybody. I think, when you look at member base, whether it's our credit union or other places, we have to be very conscious of what's happening to really the wallets of the individuals that aren't as well off, that may be a little bit more blue collar, right? And then the other thing, Jeff, we're watching is sort of the concept of digital inclusion. I think we're seeing older and rural members that just don't have necessarily the technical acumen, right, when it comes to things digital. For any of us that have elderly parents, we know the risks there are real. So I think as there's a shift to a mobile economy and one that's more digital, we're having members that are feeling left behind a little bit. So those are a couple of things we're tracking closely, sure.
Thanks, Monty. Now I just want to talk to you a little bit more about the job you currently have. How is your team using data or more modern credit scoring technologies? How do you stay ahead of credit risk while still expanding access to credit?
Yeah, no, great question, Jeff, for sure. And I'll say there's three things, and hopefully none of this is rocket science, Jeff. If other peer sets are doing it, great for them as well. So one of them is really, VantageScore has been great on this side as well as the cash flow and transaction data, right? For members that have thin files, credit files, that's something that's huge, right? Regarding the types of balances, payoff history, alternative data like rents, utilities, et cetera. We're using that quite a bit to get us a lot more sort of view into the credit profile of a member or somebody that we're bringing on. The second is really risk-based decisioning. You're hearing a lot about AI and modeling, et cetera. So dynamic credit line management, for example. I mentioned this a little bit earlier during times of holidays, et cetera, for good credit, expanding it. Similarly, watching the kind of credit exposure we allow for people. So really, risk-based pricing is critical, especially at time of underwriting. So that's something we're tracking. And then lastly, regarding access expansion, really starter limits, Jeff, for people that have thinner files, right? gradually increasing their credit lines as we get more history with the client base, et cetera. Those are some things that we're doing. As I said, none of this is earth-shattering. There's a lot of other financial institutions that are doing these things, but we really are trying to use data and really get into the behavioral science that's happening with our member base regarding what's happened with their credit files. Are they all of a sudden not paying what they used to, and what does that give us as far as intel into their risk profile?
Thanks for that answer, Monty. Last question to you. It's somewhat high level. When we talk to a lot of financial leaders, one word that comes up quite often is the word uncertainty. What lesson about managing through uncertainty would you like to share with other risk leaders who are balancing responsible lending with the need to grow their portfolios?
I think at the end of the day, what I would say is uncertainty isn't a single to retreat. I think, a lot of times when there's uncertainty that spikes, we can get a little bit more bearish. And I think really we can overcorrect or overanalyze. So really, we need to anchor decisions in principles and not predictions. I think that's sort of what I would say. We will never guess 100% right. And, I think, insurance responsible lending and meaningful access still is something that we need to be very open to. So just because there's uncertainty out there doesn't mean we need to close the shop and, go zero risk. I think that overcorrection I've seen a couple of times in my life, and I don't think it's good for the general public and the consumer.
Thank you, Monty, for joining us. Really appreciate your comments and insights there, and would love to have you back this time next year. Thanks again.
Thanks, Jeff. Appreciate the time again.
And that's a wrap for this month's edition of Credit Gauge Live. Thank you for joining us. As always, you can visit VantageScore.com to use the Credit Gauge tool itself or review the analysis. Until next month, I'm Jeff Richardson. See you then.